Step right up, ladies and gentlemen, for a thrilling journey into the mysterious realm of banks. Nestled within towering buildings, banks have long captivated our imaginations, leaving us to wonder about the secrets they guard. Welcome to Luxo-Life, your partner towards personal growth and success. Today, I shall be your guide as we embark on an entertaining exploration into the universe of banks, where mysteries abound and tales of intrigue await. So buckle up and prepare to be astonished as we unveil the secrets. Let's get into it. Ever wondered who the true power wielders in banks are? Meet the unsung heroes, bank tellers. Disguised as ordinary individuals, these unassuming figures hold the key to the secret world within banks. From handling stacks of cash to decoding complex transactions, they are the gatekeepers to finance. Step into their shoes as we uncover the hidden responsibilities, behind-the-scenes operations, and their role in maintaining the secrecy surrounding banks. Money, the lifeblood of our society, undergoes a peculiar metamorphosis within the confines of banks. Witness the alchemy of banking as we unveil how banks create money seemingly out of thin air. From fractional reserve banking to the multiplier effect, we demystify how banks multiply our deposits, creating a delicate balance between prosperity and potential financial instability. What are the secrets of banks that an average person has never heard of? Number 5. Fractional reserve banking. Modern financial systems are based on the core idea of fractional reserve banking. It is a procedure that enables banks to generate funds through the lending and deposit-taking processes, which is essential to the economy. Fractional reserve banking is widely used, although it is still mostly unknown. The term fractional reserve banking refers to a system in which banks are only obligated to keep a portion of the deposits made by their clients as reserves. The remaining amount may be lent to borrowers. The reserve requirement refers to the percentage that regulatory bodies set. Banks can lend out more money than they have on hand, producing new money. This is the core of fractional reserve banking. While fractional reserve banking offers benefits, it also carries inherent risks and challenges. One critical risk is the potential for bank runs or panics, where many depositors simultaneously withdraw their funds, leading to liquidity problems for banks. Additionally, the expansionary nature of fractional reserve banking can contribute to inflationary pressures if money creation outpaces economic growth. The banking sector's stability is closely tied to the effectiveness of regulation and supervision, and the confidence of depositors and investors. Number 4. Bailouts and Too Big to Fail. The words bailouts and too big to fail are frequently linked to the banking sector and government involvement during economic crises. Let me go into further depth about them. Bailouts are financial aid programs governments or other organizations offer to save troubled financial institutions from failure to stabilize the institution's finances and regain public trust in the financial system. These bailouts sometimes take the form of cash infusions or guarantees. Bailouts are used to avoid the systemic dangers that can develop if a large financial institution collapses. A significant bank failure might hurt the economy as a whole and set off a chain reaction that could cause other financial institutions to fail as well, resulting in a severe downturn or a financial crisis. Governments want to prevent such unfavorable consequences and protect the financial system's integrity by offering a bailout. The idea that some financial organizations are too big to fail refers to the idea that their failure would have terrible effects because they are so big, interconnected, or essential to the economy's operation. These institutions are frequently viewed as too large to collapse without significantly impacting the economy and society. Number 3. Offshore Banking. Offshore banking refers to establishing banks in countries with lenient regulations and low or no taxes on foreign investments. These financial institutions provide individuals and corporations with the means to preserve their wealth, protect assets, and engage in international business transactions. Offshore jurisdictions, such as the Cayman Islands, Switzerland, and Panama, offer strict financial secrecy laws and facilitate anonymous ownership of assets, making it challenging for authorities to monitor or trace funds. The foundation of offshore banking lies in bank secrecy, a practice that shields account holders' identities and transaction details from prying eyes. This veil of privacy is achieved through strict confidentiality laws that prevent banks from disclosing any information without the account holder's consent or a court order. While this can safeguard personal privacy, it also creates an environment ripe for illicit activities such as money laundering, tax evasion, and the financing of terrorism. Regulation initiatives to improve transparency and stop illegal financial activity have been sparked by the fight against offshore banking secrecy. International initiatives like the Common Reporting Standard, or CRS, and the Foreign Account Tax Compliance Act aim to make it easier for nations to share financial data. These regulations force banks to inform the tax authorities in international taxpayers' home countries with account information, reducing tax evasion and boosting accountability. Number 2. Banks make money on you. Lending and borrowing money is one of the main ways that banks generate revenue. Customers can deposit money with banks, which generally offer interest rates lower than they charge for loans. Banks can make money thanks to this spread or difference in interest rates. A sizable percentage of their income comes from the difference between the interest they charge depositors and the interest they get from borrowers. Banks often engage in investment activities, such as trading stocks, bonds, and other financial instruments. Through their investment divisions, banks generate profits from the fluctuations in the value of these assets. They leverage their expertise and market knowledge to make strategic investments to create substantial returns. However, it's important to note that these activities also carry inherent risks, and banks may experience losses in volatile market conditions. Banks employ strategies to maximize customer value by cross-selling and upselling additional products and services. When customers open accounts or apply for loans, banks often promote other financial products, such as insurance, investment products, or loans with higher interest rates. While these offerings may suit some customers' needs, it's essential for individuals to carefully evaluate whether such products align with their financial goals and interests. Number 1. Limitations and shortcomings of banks. One of the primary reasons why banks are often criticized is the cumbersome and time-consuming procedures they impose on customers. Opening a bank account, applying for loans, or even conducting simple transactions can involve extensive paperwork, multiple visits to the bank, and a long wait for approvals. This lack of efficiency and the bureaucratic nature of traditional banks can frustrate customers who seek simplicity and convenience in their financial dealings. Physical bank branches often have restricted operating hours, making it challenging for individuals with busy schedules to find convenient times for banking. Moreover, the geographical distribution of bank branches may cater to something other than the needs of people in remote or underprivileged areas. As a result, many individuals need more access to banking services, inhibiting their ability to manage their finances effectively. Banks are known for charging various fees, which can significantly impact customers' financial well-being. Monthly account maintenance fees, transaction fees, ATM fees, and overdraft charges can accumulate quickly, burdening individuals, especially those with lower incomes. Additionally, hidden fees or complex fee structures can make it difficult for customers to fully understand the actual cost of using banking services. Despite advancements in security measures, banks remain susceptible to cyber threats and data breaches. The fear of unauthorized access to personal and financial information looms large, eroding customers' trust in the banking system. Instances of identity theft and fraudulent transactions can further undermine confidence in traditional banks' ability to safeguard customers' assets. As our journey through the secret world of banks ends, we are left with a newfound appreciation for the complexity and intrigue surrounding these financial institutions. From the humble bank teller to the clandestine power players, from the creation of money to the global influence of banking elites, we have scratched the surface of a world that impacts everyone. So the next time you enter the grand doors of a bank, take a moment to appreciate the secrets that lie within, for they hold the keys to the ebb and flow of our modern world. So what do you think about the secrets of banks? Have you heard any of these secrets before? Share your thoughts in the comments below. We'd love to hear from you. Thank you for joining us on this journey through the secrets of the banks. Remember to like, share, and subscribe. See you in the following video.